Alright, so this is going to be a quick recap, and then I'm going to start going into the downtrend. So I'll just cover the quick uptrend and then go into the downtrend and what are the major behaviors here that really need to be understood. And you'll see that these behaviors, the reason why they're important is because you see this thing every trend. If you take a look at the SPY, the same principles that are on this chart that Wyckoff goes into, it's surprising how the same exact principles. I mean, just a few days ago, like a couple of days ago, we were the SPY was absorbing, and I knew it was absorbing, and I explained it. And what happened? It went into markup. Where did that information come from? Where did that recognition come from? It came from understanding this absorption here. And same thing happened again and again, and just happened a number of days back, I think less than 2 weeks ago. See, the thing was absorbing and then bang. So anyway, long story short, the concepts here are applicable today as they were in the past, as it will be in the future, so long as you have the same elements of supply and demand, meaning buying, selling. There's no third option here. And you have the time and price scales and the access, the time, price, volume, the same factors. So what were the key learnings here? Was that you had basically a climax, a change of behavior here, then the market was on a springboard right over here. And why did it where were the places to buy? Well, you could buy right after the climax, after that change of behavior occurred, because it indicated the climax had passed. And the second buy point was here. Why? Because there's lack of progress in the closes, and the volume had dipped significantly relative to the last down wave. So this down wave versus this down wave, meaning the climax versus the pullback has much less volume. And that basically put the market on a springboard. Other thing to mention is there was a base over here, and eventually the market broke out. Over here you had a buying climax. Over here you had a selling climax on the swing, like climax relative to swings, not trends. These were considered minor, quote-unquote, minor climaxes. Here, on the expansion of volume that terminated the swing upswing, and here, on the expansion of volume that terminated the downswing. This was the climax that terminated the downtrend. So there's a difference between climaxes that terminate trends and climaxes that terminate swings. In either case, this was a minor buying climax. This right here was a minor selling climax, as indicated by the sudden increase in volume at the top and bottom of swings. This here terminated the 5 million shares from the bottom to the top. Told you that the climax had passed. And this was a springboard. So the key behaviors here: climax ending, springboard, buying climax. And what else helped kind of understand that this was a minor buying climax is that before it you have a lot of clustered closes, or closes within a narrow range, indicating a lessening of demand as well as encountering resistance. And then this bar basically terminated. The bulls terminated because they're facing resistance and a lack of demand, as indicated by the lack of progress in the closes and the shortening of the thrust and the volume tapering off. Same thing here. What were some of the bullish indications? The high-end close here, the higher low after that, and then the dip here on less volume said that the pressure was gone, and then you had the reversal. After that, the key indications here are 1, 2, 3, 4, 5, higher high, higher low, higher closes with expansion of volume. The gradually increasing volume is very bullish as markets are going up. That's what you want to see, meaning the buyers are still there, they're still there, they're still there. That's very bullish. And then finally on this bar, it was a concern because it looked like a climactic bar, and then the market went into absorption. Why did it go to absorption? One reason was that a lot of sellers here, and the buyers were stuck here. So the sellers need to be absorbed, and the trapped buyers need to be absorbed. So they were absorbed over the course of 13 sessions. How did you know this was not distribution and this was actually absorption instead? Because it's in a narrow range that does not even go halfway back. Also on the dips there's low volume on the dips, on the red bars, and the higher supports, higher low, higher low, higher low on gradually increasing volume, which is an indication that accumulation is coming to an end, as is absorption. Both absorption and accumulation can have these characteristics where you have higher lows on gradually increasing volume. What else? Well, after that you had this bar that went up. Prior to that he had mentioned this bar, and he says that that bar has very little volume. So what does that mean? If you just interpret it from the perspective of volume, it means like lessening of pressure. But it also means that there's a lessening of overhead supply. That as price goes up, there's less supply here. So if I was to draw a line and it kind of tagged that area, and it's the volume dipped, it actually, the case he makes is that it's dipping on low volume, and that is in a way bullish. Why? Because there's less supply there to be absorbed. However, on the next bar after it, the increase in volume and the increase in thrust and all of that took out that area and absorbed it all. The overhead supply was absorbed here. So then he goes up here and says that this area here has some distribution, and he comes back down to this. So this really alludes to the idea of preliminary distribution. Why? Because this bar had too much volume, and after that this bar had a lot of volume but didn't make a lot of progress in the closes, and actually had a shortening of the thrust. So all that volume, and look at the potential of it, look at the progress, it's very little. Why? Because they're selling in it. Then the market goes sideways. He mentions that this bar here dipped on volume, as you can see, and that's a very bullish indication, meaning it was able to forecast an advance coming. So that low volume pullback bar is indicating that the market is going to attempt another rally. There was an attempt, increasing volume, after which there was a strong bar with good volume, good range, etc., that went down. This is a threatening bar. So this bar on range, volume, all of that is threatening. It's threatening because one more bar would break this low and can easily come back to test. So it's threatening. So what do you expect? You expect another red bar, but instead it rallies away from it. It rallies away from it. It rallies away from it. So they have threatening bars, but they have no follow through. Right? And then finally, this expansion here is the climax that terminates the trend. Again, different than the climax that terminates swings. In this case, it terminates both. But the idea is extremely heavy volume on what? On the bar at the top. I mean, here's the thing. This is not a breakout. This is at the top of a swing. All this volume comes in, right? It's not a breakout. It's terminating the upswing, the uptrend, with extremely heavy volume relative to the entire trend. And there's a reversal right after it. So the idea that this bar immediately has a reversal, and that reversal makes a lower high, lower low, lower close, and has a close less than the prior two closes, is telling you what? It's telling you that that prior bar is used for distribution, is climactic. So sell in it, and then this bar down has a lot of volume relative to the prior red bars. This red bar or down bar has a lot of volume. Because it has the most amount of volume in the entire trend on a red bar, it is considered a change of behavior. What is the behavior? The behavior that before this bar was that you had small volume on the pullback. See? Here you had small volume on the pullback. Here you have small volume on the pullback. Here you have small volume on the pullback. Here you have small volume on the pullback. This one was minor climax or effort reward here. In general, you have small volume on the pullback. But this bar has big volume on the pullback, telling you it's game over. So he says, why is this important? Because this is where he took his first short position. First short position was right in here. Right after the buying climax and that reversal on heavy volume, short. And this is consistent with how he explained to take his long position, because here he explained that the climactic volume down followed by the increase in the volume up is the place to go long. Climax, change of behavior. Similarly, same concept. Climax, change of behavior. Go short. Is the same thing. Climax, change of behavior. Change of behavior indicates that you have a lot of volume on the reversal, which here is a green bar or up bar, and you go long. Why? Because the high volume after the climax is indicating that the climax has terminated. Here, the high volume on the down bar is indicating that the buying climax has terminated. Same idea. So I'm going to show, later on I'll show a realistic example, and I don't mean realistic, but more current examples of this. I see this so many times. It's the same shit over and over again. If you go on an intraday basis and you see like the turning points on pullbacks, you'll see this. And I'm going to show that, which all those people on online, anyway, I'm not going to get into that, but here, how you do this, practically speaking, I show all that. And that's it. Anyway, so where the hell was I? The other thing to mention is that this green, these up bars, this is called whooping up maneuver or whatever you want to call it. It's kind of like, you see this, sometimes you see this at the end of a trend, sometimes. But enough times you'll see like there's an acceleration. So that acceleration occurred right here, where you see 1, 2, 3, 4. Accelerated price movement, meaning it has a lot of speed. Alright? Has a lot of speed. And if you draw a trend line, I don't really use trend lines that much because they make the chart look crazy. I prefer horizontal lines, but trend lines are good in that they can show you acceleration, basically momentum. They're very good for that. And they'll show you where there's a little too much acceleration. So that's the whooping up tactic. That green or up, that accelerates like that for multiple bars. This is a whooping up tactic, and what it means is that strong hands, they're winding up their campaign. Why would that whooping up behavior or that climactic behavior occur on top of the trend? If it's bullish, smart money is not going to buy on top of the trend. They're going to buy near the bottom of the trend. So over here, it's just a maneuver to get prices as high as possible so you can sell at the highest prices possible. So whooping up, what they're trying to do is get the price as high as possible, so buyers come in terms of new highs and momentum buyers and breakout buyers, and all of them are coming in. Their oscillators are green, 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 and all, whatever. So people will come in. So this maneuver is used to attract people to come in because they want to wind up their campaign and distribute. So this is what Wyckoff is talking about here. Campaign of distribution, wind it up, because they know that time to short. Alright, now I'm going to start on the next piece, which is the downtrend. I covered the uptrend. Really, in my opinion, if you know the behaviors I spoke about, this is all the behaviors you really need to know. You got your climax, your change of behavior, your springboard, the lack of supply, the breakout, the minor climaxes on the highs and the lows, the absorption, the breakout, the preliminary distribution, the threatening bars, the whooping up tactics, and what else you need? Effort reward. It doesn't really talk about effort reward, but it's right over here. There's your effort reward right here, where you have a hell of a lot of volume in that small bar. That's your effort reward. And what else? He went over the shortening of the thrust, the lack of progress in the closes. The tests, the secondary tests here, where it dips on volume. The tests of the waves, meaning the down wave to the next down wave, the automatic rally, the end of accumulation or distribution, the whooping up tactics, the preliminary distribution, how to forecast that the next move is coming based on the low volume dip. So, those are the key behaviors that you need to know for chart reading. The focus on the progress in the closes, the shortening of the thrust, meaning high to high or low to low. So all a bar has is 3 points: high, low, close. And you compare high to high, low to low, or close to close to the current bar versus the prior bar. That's all you can really do. The other thing to note, though, is the high minus the low, which is the range or the speed of the bar. You gotta know that. Because when overhead supply is removed, the bar will increase in length. So over here, for example, how is it that it can go so low and then go all the way up? That means that the supply above on these prices from 39 to 43 or whatever, 45, it is gone. It's either gone or it's absorbed, which means that the sellers are no longer there, or the buyers are so strong that they've absorbed all the orders. So that's all you really need to know. So next here is how the trend cracks, meaning this piece here that I'll be going over will explain how the trend cracks. But with all of these, this is like a full education in how to read a chart. So there you go. You don't need no fucking oscillator. On March 2nd, after a little rally, the average declined 6 points from the high of the day and closes nearly at the bottom. If we have ignored all the previous warnings of gradual weakening of the technical position, we cannot involve this backbone break. So what is he talking about right here? That, I call it the backbreaker, but it's, how do you know the trend is broken? Like, do you know based on the change of behavior in the climax? Kinda. But what is the, I don't know if to call it a breakout or what, but how do you know, like, what is the behavior? The behavior is the trend break. So typically you'll have a bar that occurs after the climax or change of behavior. There'll be a bar or a wave on a wave chart that confirms that the trend is done. Alright, this is that particular behavior. But before I go over this, I want to mention where he shorted. Like he shorts up here after the climax in the change of behavior. There. The latter now add to the supply by getting out of their longs and taking short position, thereby not only helping assure a turning point, meaning confirming that the turning point, but also placing themselves in a position to profit by the downward swings. All I'm saying is, what he's saying is they're just selling the highs. That's all. Buy low, sell high. They're selling a high. That's what that change of behavior is selling high. So that's the first short position. All right. Now we must act in harmony with these short operators and put out more shorts. Action of the 27th. This fucking thing is so difficult to read. 27. I don't know. Right here is a little smudged, so it's a little tough. As the action of the 27th gives us a new selling point. Uh, 26. On March 2nd, after a little rally, the average declined 6 points and is closed nearly at the bottom. If you have ignored previous warnings of a gradual weakening of the technical position, we cannot ignore this decisive breaking of the very backbone of the trend or the advance. This day's behavior shows definitely the heavy withdrawal of bids underneath the market, and the volume remains high, very high in comparison with the volume of all previous reactions since December 8th, indicating that very substantial lines of stock are being pressed for sale by large interest. Having accepted some or all of the bearish indications of the foregoing 6 sessions, we conclude that the upward trend has terminated after running a great part of multiple months, 3 months here, and that a change to a downtrend has begun. That is to say, that's going to be a big move down. It looks that we're correct in our assumptions that some distribution was accomplished as early as February, but the main move up was continued to order facilitating of unloading of stocks that had not topped out. Alright, so a couple of things here. Over here on the left hand side you have distribution. Alright, preliminary distribution. So why did the market make a new high after distribution? Because when markets distribute, they don't just there's a lot of sectors and a lot of industry groups, so you cannot just sell everything at the same time, right? So what'll happen is you sell technology but advanced financials, or you sell financials as advanced technology, right? So you do one and the next, right? So imagine over here that financials were distributed. Alright, now on the financial sector and whatever on those industry groups, they're going to be going down. But you cannot do everything at the same time, so continue to advance technology and the semiconductors, for example, advance them, and then dump them. And eventually, once you do all of that, the semiconductors and technology will also be sold off. Alright, so that's why preliminary distribution is used to sell part of the market, and the rest of the distribution is to sell another part of the market. Alright, because there's a lot of sectors and a lot of industry groups. You can't sell them at the same time, so you sell piecemeal. First this, then that. So that's why preliminary distribution is just indicating that, yeah, distribution is occurring, and you know, one a couple at a time, one piece at a time. Because if all of the sectors, they all go down at the same time, you won't get the best prices, right? So let's say, just for sake of argument, let's say you move technologies, whatever, Excel, I forgot what it was, XL whatever, you move it up to let's just say 100, then sell, right? And then you want to move financial XLF or whatever all up to 100 also, and then sell. Otherwise, because they're at different prices, you want to sell at the best prices. So you want to keep advancing whatever you can advance and sell, like do that rotation. At this juncture, we should be on alert for opportunities to sell such stocks as shown by their individual charts and group charts to be in weak position. Here's the point. Alright. You have to use group charts to be in a weak position. These should be sold short on bulges. Why? Because you're going to get halfway back. So you're going to get that test or the pullback. Sell them. And the fact that the averages have declined from the top about 10 points is an indication of a partway rally, which normally is likely to fall slightly short of about halfway back. So what is he just saying? Alright, if it went down 10 points, it's going to come back up 5 points. That's the bulge. Look for the turning point. Bang, short. Alright. So under these conditions, now we should liquidate investment as well as trading long positions for, even though it may develop that the major trend will turn upward again, we can get in again later on. So all he's saying is, look, don't be buy and hold when you see distribution. You don't need to hold. Don't be buy and hold forever. When you see distribution, get ready to exit the market, short it, and when you see accumulation, get back in. So that's his mentality. It's the basically swing trading mentality. All right. So what happens here is the market goes down, ding, 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 breaks this low, right under support. So acceleration of down movement, meaning there's a lot of speed, and when you have that, what's going to happen? It creates an oversold position and touches a former support level. So when you have these two conditions, market is oversold and at support, what do you think is going to happen? So there's going to be a bounce. So that's what happened. Why? Because people want to buy support. Well, if you ask long buyers, where do you want to buy? They're always going to say the same shit. I want to buy support. I want to buy pullback to support. Whatever. So if you have that pullback to support and it's oversold on those indicators or whatever, longs are going to come in. That long buying is going to trigger some type of pullback. And when it runs up on light volume. Okay. On the 5th. So that's the bar right here. It comes up on comparatively light volume, a further rally to a higher top and a higher bottom next day to confirm our anticipation of a possible turning point for more recovery. It's just telling you, sudden increase in volume on the 6th may indicate the climaxing of the rebound. All it's saying is that's actually a minor selling climax that's going to initiate a couple of bars higher. So some folks will see this bar and they'll see increase in volume and whatever and just go short, not realizing that this is like actually something else. It's not the reversal break. It's this right here is the comparatively light volume up Second day, it climaxes down, setting up the bounce. So it's a little confusing, but it's just something you have to understand. Here you go. It says that the volume of the previous session was climactic on the way down rather than the up, selling climax. This demonstrates of a change from technical weakness to technical strength, which is not really strength, but it's enough strength to set up the rebound, right? And start a partway recovery. So when this partway recovery occurs, here's what you expect. You expect that, yeah, it's going to recover, but no, it's not going to get people out. They're trapped, period. Alright, so it's basically a 50%, not 100% retracement. Why? Because it's 100% retracement. All these longs that are trapped would be able to get out. So they don't want them to get out. Large interests would not be willing to help the market far enough into the distribution area to let the public out even. Right there. Stated another way, our reasoning is that a partway recovery would now be a normal development, but the CM would be anxious to run the market back to the February tops only in the event they saw an opportunity of pushing prices far enough above those former highs to realize a profit on the offerings. They would have to take from the buyers who are hung up, basically absorb them with stocks at these levels. Even should they see such an opportunity, it is more likely they would prefer first to tire out or shake out this overhanging supply. However, we reason further that in the view of the extent of the distribution as indicated by the heavy volume and breadth of the February campaign, the greater possibility is that they will manage just enough recovery to discourage amateur shorts from selling and to keep the February buyers locked in which they at the same time would distribute more stocks on rallies to a low top, to a lower high. What does all this shit mean? Alright, that's the point. Point is, you got all this distribution, then you have this break, then you have this low, then you have a potential bounce. What about the bounce? Okay, if it's not a bounce, that means that if the trend is going to continue up, what does that mean? It means that it will go straight up here, there would be absorption, and it would be a massive move up, similar to this behavior over here, where you see the prices go up to where buyers are trapped, absorb them, and then bang, take it up. Same thing here. It would need to come up to this prior high, absorb, and go up, mark up. But there's so much distribution here that, the strong hands are like, forget it. I'm going to break the market now. I've taken my short positions. I've sold, distributed my inventory short. What do they want to do? They want to take the market up so they can sell more without having the trap longs get out. That's why this is halfway back, not full way back. Because if it was full way back, the trap longs would start exiting the market, and if they exited the market, who's going to have to take the other side? CM. CM doesn't want to buy, he wants to sell. So the reasoning is, yeah, you're going to come up around halfway, I'll sell some more and break. continued distribution. All right. So it is more likely that they would prefer to tire out overhanging supply. However, we reason further in the view of the extent of distribution as indicated by the heavy volume of breadth. They will manage just enough recovery to discourage amateur shorts from selling and to keep the February buyers locked in while they at the same time distribute more. So how do you stop amateur shorts from selling? Amateur shorts, they'll probably just sell the new low, or it would have to be at a resistance area. So for example, if this comes to the resistance area, they look to sell, or they'll sell around the lows, like right here. So on a break. As buyers continue to buy new highs, amateur shorts will just look for support and resistance, and they will also look to sell new lows. So manage enough of a recovery to discourage amateur shorts from selling. How do you do that? Don't take it up all the way. Just take it to that 50% level. If you take it all the way up to like 90% or 100% or up thrusted, shorts will come in. So keep it around 50% so it's not a support resistance area. And that would discourage the amateur shorts from coming in. At the same time, what else you want to do is not let the trapped longs out. So where the longs trapped, they're trapped up here, don't let them out, because if you let them out, they are going to sell and the CM will have to buy, which would lower his inventory of shorts. So now look at what he does. He says the volume on the rally is not measuring up to the prior rally. Alright, so what does that mean? It means that you have this rally here, right? Alright, so look at the volume here. It's about 3 million. You have one bar that's about 4, which was a climax, but in general it's around that 3 million area, right? So that's this rally. Now look at the prior rally. What did I do? It's much higher. You have 4 million, you have 5 million. So this volume on this rally is a lot more than volume on this rally. So I guess you could use wave volume because that's what he's doing. He's looking at the waves. Volume on this rally is not measuring up to the standard of the February rise. Alright. Marks this rebound as purely technical and indicates the exhaustion of buying power. Buying power, buying pressure, as a result of filling up all the buyers on the previous distributive movement, thus confirming the probable accuracy of other deductions. Alright, I'm going to stop right here. So basically, you got a lot of volume up here. There got exhausted. Volume then on the pullback, much less. Why? Because they got filled up. And buyers are getting exhausted. That's all. So I'll probably do the rest later in the day or maybe tomorrow or whatever. Alright, take care. Bye.